Larry. Larry, my question is about the deterioration of liquidity in markets. So there are three structural changes that have happened in markets that make this far more dangerous today than in the past. The first is that the number of heterogeneous market participants has decreased, and the ones that are playing now are much bigger than they were before. Second is that there's a lot more algorithmic trading happening in the market, which many of which are similar to each other, which means that herding behavior is more prevalent. And the third is that the market intermediaries are playing with far less inventory than they did because of capital rules and just lower economics. So it feels like there's a supply-demand imbalance, and if there's a sudden rush to the exit, we may find ourselves with the next major financial crisis. Wonder what your view of that is.
Never say never. I think the scenario you describe is a risk and a real risk. I think the experience has been, and the experience is short, and I'm with you on there needs to be a lot of thought and then a fair amount of action to correct the set of issues that you described. On the other hand, if you take 1987 is in a sense the classic example of what you just described. Markets were stretched, they were overvalued, fundamentals and everything were kind of okay. There were problems, but were kind of okay. But there was a massive market breakdown which produced a massive event. If you look back, if I showed you a set of data on all the economic statistics and I didn't label the dates and I said find 1987 and its aftermath, you couldn't do it. Things slowed down for a little bit in the fourth quarter. So I don't know that we have examples of market structure crises breaking down that have turned out to be fundamentally important economic events. If you look at the 2008 crisis, if you look at the Depression, if you look at the Asian financial crisis, if you look at most of the crises we remember, it was about something more than there being a moment when markets couldn't handle all of the pressure. So if you said, what are the odds that there'll be another moment when the 30-year Treasury moves 50 basis points in 11 minutes, or the Dow makes a 1,700-point round trip in 13 minutes? If you said, what are the odds that something like that'll happen? I'd say abnormally high, and certainly higher than they've been in the average year in the past. But if you said, what are the odds that that will happen in a way that will lead to an extra million people being unemployed? If we have a downturn of that kind, I think it's more likely to have to do with the somewhat larger and more fundamental forces that I talked about when I sketched an adverse scenario, which is no reason not to be very worried about the question you raise. Just I don't think it's the primary financial risk.
Okay.